All right, guys, welcome to the Trader Pulse podcast. It is Wednesday's midweek report, and I've got a lot of exciting stuff to get going here, including bank failures, some of my top picks, which happen to be crypto related this week, and some interesting things to look at regarding the Buffett indicator. I thought we'd bring that old tool back up to the surface. There's some interesting stuff going on there. So without further ado, we're going to get started here. Thanks for being with us. All right, guys, welcome. Glad to have you here on with us today. We're going to be talking everything from winners and losers. Let me go ahead. As we are live, I want to welcome our YouTube live members today also, and welcome to the Traders Pulse podcast. Today, I'm just going to bring this up and just jump right in. We've got a very short 30 minutes, and as you guys know, it is my commitment to deliver the most valuable content possible in the shortest period of time, and so we're going to go right into this. The first thing we're going to talk about are our 5-day winners and losers. And I just find like this is really valuable for traders because you want to know like what's kind of happening within the last 5 days. I've been working, I've been doing my thing. And so it's like, yeah, let's dive into that. Let's get down to the nitty gritty around what is actually going on in the market and how can I make sense of it? And maybe there's some opportunities that you'll gain from today's webinar. As we disclosed in the disclaimer, this is for educational purposes only. And so anything I say today, you need to go do your own research before you make any live trades in the market. Having said that, there's some stuff to talk about. So here's one of the things that I thought was really interesting. In the last 5 days, we had a lot of big winners, big losers, and I found that the polarity between our winners and losers were kind of directly correlated. And you're going to see this. One of the industries that had our largest winners this year was the crypto industry. And one of our largest losers was actually in real estate. And I would tie that to like real estate and banking, right? It's like banks, but because of real estate. So as things start to collapse, as the economy starts to drop, it's no surprise that we would see this, right? It's no surprise. And let me get this more in focus. It's no surprise, guys, that we would have this happen. So Coinbase hit the winner. I mean, look at this chart from this week. This is a 5-day going all the way back past May 5th, so into the last week. And we have just seen incredible gains, 28% in gains over the last 5 days. And so a lot of you guys would be going like, what is going on? What happened? How did this happen? And I want to do a deep dive with you, or as quickly as we can, so that you can actually see for yourself what is going on in the crypto world that I should be paying attention to. And is this just a flash in the pan? You know, I always say this to our traders. There's never a bad answer to which way you think something's going to go, at least 90+% of the time. And what I mean by that is I used to do these huge seminars, and I got a big seminar this Friday that I've been asked to speak on. And we'll be doing a lot of like psychology of trading during this time. We're going to be talking a lot about like how people show up inside their training and their mental state and what they surround themselves by, because that impacts your trading quite a bit. But usually, not always, but usually when I do these, I'll typically ask the audience like, hey, here's a stock, or here's an index, or some type of thing that could be traded. And I'll say something like this: write down on a piece of paper, how many of you are a buy? And then I'll ask the other audience, how many of you are a sell? And the answers typically come in pretty close to 50-50. It's actually fascinating how they do. But when you only ask the question that way, it really leaves the world open, right? Is it a buy for a week, a month, a year? Is it a sell for a week, a month, a year? And so you could see how like, okay, short term, I'm thinking it's a buy. Long term, I'm thinking it's a sell. And both people could be right. So don't take this massive gain in Coinbase as a long-term run. Is it running that direction right now? Yes. But I'm going to give you some things to consider before you dump a bunch of money into Coinbase Or you might be waiting for that other side, right? The other answer, like, oh, I'm going to put Coinbase on my ticker because Matt said something that if it happens, that might be a trigger or a fundamental alert to start selling this thing off. So here we go. 28%. Obviously, you can see the 5-day climb looks good. There's no PE ratio. This is a growth stock. I pulled up. So I went on to Coinbase's site to get their last quarterly report, and this is for their investors. And I thought this was really interesting. So I'm going to bring out some of the highlighted data that came out on Coinbase. And as you can see, how does something that from last year, year over year, their net revenue was almost double, not quite double, but you could say about 30 to 40% higher than it was today. So this is not great news. However, their net revenue did come in above what they projected. So the forecasters did not think it was going to come in this high. And so this is good news. We could talk about where the revenue is coming from, and I'm going to do that actually now. Next, I'm going to break this down. But if all you saw was net revenue and all you saw was the forecast and what it came in at, you go, I'm in, I'm a buy. And sure enough, guys, no question. Did the market react to that? Absolutely. You can see that here. So, I mean, that's great news. Net loss, same thing. Lowest net loss we've had in over 4 quarters, the 5th quarter being the best. And then obviously your adjusted EBITDA is going to be pretty high because revenue is just up. So, I mean, there's a lot to say here. I'm not going to go into this results versus outlook thing. This is kind of a selling point. But, I mean, I put a bullet point here. Long story short, revenue is up, but not compared to last year. So it'd be interesting and valuable to know where the revenue is coming from. So here we go. Coinbase net revenue. I think this is such valuable information. Transaction revenue. So you've got net revenue, and you got 2 categories, transaction revenue and subscription revenue. And you're going to see a large discrepancy in the two, which I actually think may create an opportunity in the future. Here we go. So number 1, consumer net. This revenue is transactional, right? So transactional revenue is based on how many people are on the platform, how many people are making trades. And so therefore Coinbase would get a spread or a commission based on transactional revenue, meaning lots of buying and selling, right? They're the broker. That's how generally these people make their money. You can see that number is awful. Year over year, it was at 965, currently sitting at 352. That's almost a third of the volume at Coinbase. A third, guys. This is really bad news. And it'd be interesting to see a chart, right? Like on a 5-year, how we were talking about who's a buy, who's a sell. Based on this data, I would not be very bullish on this. However, the forecast was higher than they thought, and you can see it's a great rebound from Q4. I do have something, and I put this at the end, but there's actually a lot of Bitcoin transactions happening right now on all markets and all brokerages, and Coinbase happens to be one of them. And so a lot of my assumption, this is, I'm not saying this is fact, but my assumption is a lot of this is actually coming in from Bitcoin transaction. Institutional net revenue also came up significantly higher, almost more than double, or at about double. So to see institutional transactions going up quite a bit compared to the consumer, this is good news for the stock quarter over quarter. Year over year, it's about half on the institutional side, and it's about a third on the consumer. Now, here's the subscription side that I would get really excited about, the side that I think you guys should all be paying attention to. Blockchain rewards and custodial fee revenue, it's important. You can tell that it went up a little bit. The blockchain rewards, they made a little bit more money, but not as good as, again, year over year. And then custodial fee revenue, you've got a tick up, but again, there's just not that much revenue coming in from that. So that's not where the focus is. But look where the big money making machine is. It's in interest income. And so we've got to understand, it's really important to understand, how does Coinbase make money from interest income? Well, before interest rates were high, the cash that they had on hand, and by the way, there's 2 sources that they have their cash on their balance sheets. And one is just the cash reserves that they hold. And then what do you do with a cash reserve that you hold? Well, you put it in bonds, right? You put it in notes with treasury notes. And because rates have gone up, the returns on that cash on hand has created significant cash. And you can see that from the last quarter, Q4 also. But because rates continue to go up from last year, they're even making more money. Now, there's one other place where they are making a ton of money on their balance sheet, and that is in their 50% stake in USDC. Now, USDC is also has its reserves, also has its cash holdings. They do the same thing. They are holding inside of bonds and notes. And so naturally, as interest rates go up, the return that comes from owning that investment goes up. Therefore, you have high net revenue. Now, where is my concern? My concern is even though the return from USDC and owning 50% of that stake, and by the way, that's a shared stake by one other company, but that revenue is going up at a significant rate. But is it going to beat the rate at which people are leaving USDC? And if you guys get on the news or you look anything up, everyone knows that people are leaving at a really fast rate USDC. A lot of it has to do with this. I mean, there's just a lot of negative sentiment around regulation around USDC. There's been certain political figures that have kind of made it their personal goal to like ban anything pegged to the dollar. Warnings from certain individuals that the USDC could fail or the government may ban it, blah, 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 whatever. Because of this fear, people have been leaving it. And so the rate at which people are leaving USDC, at the rate at which interest rates are increasing, obviously we've hit a point at which it's going up faster because of interest rates, beating out the drop in people leaving. Now, that's where I would be watching this because most net revenue is coming from interest held in bonds and treasury notes, held on these balance sheets. It's not actually coming in from what the company should be doing, and that's transactions by you trading. I would say I would be watching interest rates really close, and as interest rates actually drop, you're going to see interest income drop significantly. Therefore, the returns they're either going to have to increase their trade volume and how many people are coming to Coinbase to get that trade volume, or they're going to have to find another way to make money to keep stock values up. So keep an eye. If I were to put an indicator on Coinbase, what would I be watching? I would be watching interest rates. I would be watching when the Feds start adding quantitative easement back into the country, meaning we start to see rates start to lower. And if that happens, next Q2, Q3 is going to be impacted by that significantly. All right. So that's our big winners and losers. You can kind of see what I was saying, the opposites, right? We've got this crypto company as the winner. Let's jump into the loser, which is the opposite, is the bank side. UWM Holdings Corp. This UMW is it's a bank, and they have significant holdings in real estate. And what happened in the last 5 days, and I'll talk about the article in just a minute, but what happened is they got rated pretty hard. And if someone had a crystal ball for these ratings, if someone could get those before they happen, typically the market is impacted, or the stock price is impacted pretty heavily by these reports. We'll talk about that in just a second. But you can see, guys, UWM Holdings Corp not doing great. 17% drop in the last 5 days. Most of it happened when? In the last 24 hours. And why? Because of their MSR value. And this is a great article that I saw. UWM Holdings stock swoons after Q1 revenue slammed by MSR value change. And what's causing this? Well, first off, I think it's valuable to know that the MSR value is the mortgage service rights. It's like Experian for your credit. They go and they rate these companies so that the public and other investors and people can have a good sense of like how strong and stable are they. And the drop that they had is actually what caused this 17% drop in the last 5 days. You could really even say in the last 24 to 36 hours it happened. Why is that significant? Well, it's because of these loans, guys. And I've been watching the banking industry really close as a trader. In fact, the places we're going to catch the most volatility right now, the places we're going to see the most gains, if you're a trader, a short-term scalper, or someone who's trading more short-term, it's going to be banks right now, and it's going to be crypto. And they're going to be the most volatile, risky for sure, but highest reward. And if you know what you're doing and you know what to look for, and you start putting some of these on your watch list, you'll start to learn the things that impact them. And there's often even follow through after the announcement. If you know what to watch for, and you're like hunting the announcement, you know how it needs to come out, you likely can catch some of these runs if you get in early enough. One of the things, if I were interested in investing in, because I would buy into banking if the time looked right. But if I were looking to short banks right now, one of the things I'd be looking at is like, what affects this MSR credit score, or this MSR value for banks? And one of them is CREs. And I would say this is the riskiest. CREs, or commercial real estate loans, are the riskiest loan. CREs are the riskiest loans in banking in the US today. So what are CREs? Well, it's the part of banking that the loans are allocated for commercial real estate exclusively. These are not bridge loans for commercial real estate. There's a whole nother section of how much of those loans are going into like new construction and bridge loans for construction. It can be applied even towards commercial, but these are actual long-term commercial real estate loans that are not currently under construction or a bridge loan. And guys, here are the top 7 banks with the highest CRE percentages. So if you're a bank, you want to, diversify. If you're smart, you're going to do some auto loans, some home loans. You're going to be investing in some other sectors and areas. But overall, you're going to diversify. So why? So your MSR score is really high so that your stock doesn't do this, right? And go through the floor. So CREs, the percentage that you're in, like that a bank is in, is obviously going to impact what's going on with its stock value in the future. And how many of you guys are aware of the commercial real estate crisis that we put ourselves in? Well, let me just give you, before I go through this chart, let me kind of give you some quick background. So in commercial real estate right now, people are weighing out in a recession with rates continuing to climb over and over again. Who's going to get hit the hardest? Is it going to be residential or commercial? Well, residential, the prices went up so fast, so hard, and we still have really great employment for now for individuals that they can keep paying their mortgage. And most people locked it in at a rate for 15, 20, 30 years at the lowest interest rates that we've ever seen in this country. So is it likely we're going to have a residential real estate crisis? Probably not. This will have to happen first. It'll have to happen in the commercial real estate sector first, and then residential next. I just can't see a world where residential would happen first and then commercial. And here's why. And it's because I'm in a bunch of commercial real estate. In commercial real estate, you can't get 15, 20, 30-year loans. And most people don't know that. Most loans are 3, 5. You might get something out to 7 to 10 years, but no one does that in commercial real estate. Why? There's 2 rules. Shorter usually is cheaper, meaning that the interest rate is lower. And second, because the bank typically does this with no one on the hook. There's no credit. There's no person at the end that when they default, they're going to be actually they'll be able to go after them. And so are a lot of these CREs, are these loans not personally guaranteed? Yes, a lot of them are not. In fact, most of them I would say are not. Are they more short-term? Yes. And so what does that mean? Well, people who got a mortgage for their commercial building 3 years ago, their loans due today, meaning they have to adjust. And what is the rate difference between then and today? And how much of that percentage makes their mortgage go up, their payment for their commercial building go up? And if vacancy rates are anything like we've been seeing, like San Francisco is a freaking mess right now. You can go to San Francisco and find commercial buildings that are 50% unoccupied. Now you take unoccupancy rates because of COVID, because of people not returning back to the workplace, and then you multiply on top of it, hey, we've got to refi, we've got to renew our commercial loan, but this time it's at 6%, 6.25% versus 3. So most of them, by the way, that'd be a really great rate. Most of them are coming in around 7s now. But that double in interest rate doesn't make most of these businesses work, even if they had the same occupancy. So are we going to see more defaults on commercial buildings? Absolutely. We're already seeing it. It's already happening. So I would be looking at, and that's why I have this chart up, who's going to have the most defaults, because that's going to be a huge signal to how the stock performs. So here we go. We got Pacific West Bancorp. Frankly, no surprise there. Key Corp, I haven't paid a lot of attention to them, but you can tell they're the lowest on the chart. And by the way, these are commercial real estate loans by quarter. First quarter of last year, fourth quarter of last year, first quarter of this year. And so I actually like seeing Pacific West doing this. This is a great sign. They caught wind first quarter. They probably didn't renew any commercial loans. They started investing heavily in obviously different loans. So their percentage radically shifted. And there's reason for it. They have weakness. You're seeing a lot on the news right now about Pacific West. And I think it's because they knew if they hadn't shifted quickly, they'd be in a world of trouble today. E Corp, don't know much about them, but you can see they're the lowest on the chart. But still, this is like the top 7, guys. Zions Bancorp, pretty high, over 20% of their loans are in CREs. Western Alliance, right about the same. I don't know what they were thinking, why they got back into commercial loans, unless Western Alliance started seeing some of the deals coming online and they started buying into commercial real estate. But my opinion, that makes no sense. Western Alliance shouldn't have done any more percentage-wise in their portfolio. This is not a good move for them. Commercia, we're talking 30%. East West Bancorp, East West Bancorp, 40%, guys. 40% of their loans are in CREs. And then you have M&T Bank right between the 30s and 40s. This is what I would be watching. I would put, at one point I had a list of the top 100 banks. I might do that again with you guys just to kind of go through all the different banks that are out there and what percentage of them are in CREs. And this will give you a general sense, because a lot of people are just shorting banks in general. And it's like, no, you've got to know who your strong ones are and who your weak ones are. And there's opportunities like we had I said with that meeting, buy or sell, you're probably both right. There's probably some great buy opportunities in banks that are going to be coming up that have very little exposure to this, but they've been hit because the whole banking sector has been hit. And then there's going to be some that just missed the boat, right? The income was high, or they had high net returns last quarter, but their CRE is really high. And it's just like, I don't do the math, look them up, go through all the technicals and fundamentals, but it's very likely things are going to get worse short term before they get better long term. All right, so there's our bank stuff. I thought I'd do something fun tonight. Wow, this goes so fast. I want to go and just have you guys look at the S&P 500. So I want to give you guys some value tonight. we're going to stop the share. I'm going to move over to our charts. And I wanted to just give you a next day read on the S&P 500. So let's go and do that really quick. So here's the S&P 500, guys, and I know I'm running out of time, so we're going to make this quick. But here's the S&P 500 today. This is running live. So if we zoom in here, here's the candle that's actually formed today. Here was the end of today. We kind of had this large up and down movement. But I'm going to give you a quick read for what I think is going to happen tomorrow and the rest of this week, so that for those of you who are watching the markets, you can look back on this and you can count on the trader's pulse being something that helps push you in the right direction, really gives you some insight if you're making any type of investment decisions throughout the week. And I'm not going to be right all the time. And again, this is just my opinion, but it will give you something to go look for yourself before maybe you make a mistake in the market. So this is a 4-hour chart I've got on the right side, but let me just do a really quick technical analysis on this. And I'm going to show you, we have some really significant things I would be watching. First is we have insane resistance at 4199. And I've actually seen this on the news quite a bit, that breaking through 4200 is just really hard to do right now. The market cap that would be required, it's pretty high. But are we in an upward trend? Well, since March, you could say absolutely. Like, we are definitely in an uptrend. And I want to show you some things that happen with just basic technical analysis. And these are just my base level ones that I like to do. I'm going to throw a channel in here. I'm just going to show you this. And so you can see the price from a non-linear trend has been going up. And you can see this kind of price channel, these support and resistance levels that the price has liked to stay in since about March 10th. Around March 10th. So about 2 months. And you can see it's kind of topped off and then come down. You can definitely see that this 4199, or we call it 4200 ceiling that we've got, it hit, and that's what actually caused it to come back down, then hit again. So we've actually bounced off of, you could say, the 4200 range twice, which does create some pressure. But this channel, guys, has a lot of room. Like, look at this. I want you to just see the level of room that we've got. And this plays in huge, very largely into what the price will do tomorrow. There's pressure pushing this down. So from 4,200, this resistance level is pushing price down. Our support level, though, that's nonlinear, is going to keep going, right? And it's going to keep going. But is it going to happen tomorrow? No. Thursday, Friday. I would predict the price is going to stay within this range. So if I were watching this, I would not be getting too worried about the price getting extremely volatile unless there's just some insane fundamental news. So this would be the price range I'd be looking at. It's going to be right in here somewhere, guys. And so come back on Wednesday, check the chart, but it's very likely between now and Friday, it's going to stay below 4,200, likely maybe a little bit below 4,100, but that's where the price is going to range. All right. Another quick analysis. I'm going to just give you a quick 4-hour analysis because we just love giving you guys good information. You can see we had lots of movement today, but the 4-hour, you can see, I'm just looking back. Yeah, we don't have a great trend there, but I'm going to pull it up anyways. We've got a little bit of a micro channel that this is running inside of. I don't love it because we haven't hit the high. The high is getting close to 4,200. So again, same idea. We're seeing some upward pressure here. The trend is definitely short-term up. For the last month, it's up. So you have two trends going up. As far as support and resistance levels, if you wanted to really break this down and get granular, there's something going on. This price right here. And then you can also see some support clearly here at about 4,100. And that's about what we said. So I'm not seeing much difference between our daily and 4-hour chart. It's about a similar read. Let me share this with you. You guys are going to love this if you like that. So here is a technical read. So from the S&P 500 on a daily, this is a technical summary. And I actually pulled this off of TradingView, so you can't get mad at me. Love those guys. They're competitors of ours, but they do a really good job of this. The 1-day chart, you're showing a buy total summary on technicals. Oscillators are showing somewhat neutral. Moving averages are showing a very strong buy. So if you're to look at all the oscillators and moving averages, here are the ones that they pull in that comprise these data sets. So you can see oscillators pretty neutral. One of them in a sell, one of them buy, so pretty neutral. You can see why it's saying that, but moving averages are just off the rails right now on a buy. So if I were to take this and go back into my charts and say, okay, technicals, my technical indicators are saying buy, what would I do with this? Okay, if I were looking at something that were a buy, I'm not saying to go do this, but if I were looking to do something that was a buy, I'd want to make sure that I set myself up in a way that's probably a buy. It might be from current, but I would be really hesitant about the support level that we have, and definitely this 4,200 level. So what wouldn't I do? Well, if it was a short-term trade, I'd want to take my profits somewhere up in here, right? My profit to be in here, and then I'd want my stop to be down here, you guys. Somewhere below the resistance. And so this sets you up for a pretty decent trade. You got to let her breathe a little bit, let her air out on the top side. This would probably be a trade that would fill within by Friday. So this is like a shorter term trade. Again, you ask the room, buy or sell. It just depends on how long we're talking about. But up until the end of the week, TradingView's indicators are saying this is a buy. I would agree because of the trend. I would agree because of, you can actually see here, the macro trend that we have here on the daily. Like since last March, and what's the old rule? Trade the trend, right? So S&P 500 looking definitely more bullish from a technical. What could screw that up? Some fundamental news, right? Something comes out on the news or something we weren't expecting that just radically changes this before Friday. So trade with caution, make your own decision on this, but that's my 2 cents on the S&P 500. All right, so running back, we are already there, guys, but I want to make sure that we wrap things up. Let me give you the last piece of this, and then I'll let you guys get to your night. And then I'll see you again on Friday. We'll do this again Friday, and you'll have me for an hour next Friday. If you came in a little late, you can watch this in our live section on our YouTube podcast, by the way. We'll keep doing that. And let me just bring this back over. And I want to end with this. So ending on this note. So Warren Buffett's indicator, this is the last piece that I wanted to talk about. I haven't done this for a while. I'm going to do it really quick, but the Warren Buffett indicator is the ratio of the United States stock market to GDP. So gross domestic product, we weigh it against the value, the current market value of the stock market. It's the Wilshire 5000 actually that we plug into. That's not the S&P 500 or the NASDAQ. It includes all of that. So 5,000 stocks. And this is it calculated as of May 5th. So this is really relevant, guys. This is only 5 days old. Current market value is 43 trillion, but GDP is only at 26. So that's 165%. When you look at the charts, here is the standard deviation of the trend lines. Right now, we are still overbought. We are overvalued and to a high degree. I remember doing this right after COVID, and we saw like the spike after COVID, after some of the stimulus checks were going out and the M2 money supply was starting to go up. Things got way overvalued, way overbought. And what does that mean? Overbought is like the last thing and last time you want to buy something. You want to buy something when it's down here, when it's oversold, right? The Warren Buffett style of trading is you buy when there's blood in the streets. Now, that doesn't mean you buy everything. You just buy solid companies with strong teams, strong management, and good earnings. And you buy it when things are way down here. Are things way down here? No, they're not just like average. They are overvalued. And there's a lot of reasons why this happened. We still have way too much cash in the market. We have way too much cash in our country. It's M2. That's our government's fault. It's our political process fault. It's all the stimulus money that went both to individuals and corporations, but that amount of cash injection has not worn off yet. And thus we had inflation, which also creates overvaluing at times. And it also created the Warren Buffett indicator to go overbought. And we've been overbought, guys, for a while now. When was the last time we were overbought? That's right. It was during the .com. And you can see that here. 2008, we were a little overvalued, a little over average, but you can see it was not where it's at now. So is this a good time to buy long-term stocks or buy things for the long haul? Well, the Warren Buffett indicator would say no. It would say hold your cash. It would say hold your assets. Wait for a better time to buy stocks for the long haul. So as a day trader, are we loving this? Absolutely. We don't care about this. We're not holding positions long term. If you're invested in something like a mutual fund or 401k, or you have someone managing your funds, is there room for this to go down? I would say absolutely. And the biggest reason is this: GDP. Gross domestic product, I do not anticipate during a recession to go up. And there are a lot of analysts saying that next year we are going to be worse off than we were this year in GDP. So unless somehow the market just drops out and we start dumping cash out of the market and pulling out of stocks, which would cause the market to crash also, we are not going to see this drop anytime soon. It's going to stay overvalued as long as GDP stays low. We need production to go way up in order for this to drop down, and we're just not seeing it. Now, do I think there is a savior to this? Yes, I think there are a couple. Are there some things that might save us out of this recession and this inflationary period? I would say yes. One of them is energy independence. If we could get energy costs down to zero, and there are plans that make that possible, I believe that is one way. The other is AI. I actually think artificial intelligence and the rapid rate in which we are accelerating that could, on an insane level, increase GDP, specifically for this country. There's no question we are in the front of it. And if you can do more for less, that increases GDP. If you can, but it's bad for employment. Less employed often results in higher GDP. Less people you have to pay, but more production you're getting out of them increases GDP. Thus, Warren Buffett indicator starts to level off. And you just really hope, guys, we can get it back down here where things are a buy again and things aren't so overbought, right? And you guys know this. Those of you who have tried to buy a car in the last 2 years, a house in the last 2 years, the market was just cooked. And in the last year, has it come down? Yeah. Anyone shop for a used car? It's like, yeah, those prices have definitely dropped. House prices, don't live in an illusion. They have been dropping this year. So yeah, that's the report for today, guys. Yep, glad to be on here with you. We will be doing this the same time, same place next week. And then this Friday, I do the same thing for an hour at 9 o'clock. So if you like this, be there for Friday. Obviously, like, subscribe by hitting the buttons below. And if you have something specific that you're dealing with, some amazing idea for like the next podcast or the next episode that I do, let me know. And I will do my best to fulfill on that. I plan on bringing in really cool guests. I plan on having people and experts that are going to give you guys the latest information, but about the most important topics. And we're going to do this together. We're going to elevate our current financial situation together, and I'm here to help you do that. So tune in next week, and we'll see you Friday morning, 9 o'clock. Thanks, guys.